Very good morning, friends. I hope you're all doing good. And as expected, your cumulative revision is going on. I also have my constructive obligation at the very beginning, always to give you some mind maps on the previous learnings. And that's what I am going to do right now as well. So let me remind you, we were working upon the concept of financial assets. The focus is Index 109. And we've learned the inputs in terms of how the accounting of financial assets is done in 5 cases. We've got 3 cases in debt investments, and we've got 2 cases in terms of equity investments. Though you can also add another 6th case as well, which is a case of a derivative investments, which is always measured at a fair value through profit and loss. So to put it in short, this we've already covered in the mind map last class. And that is, if you look at equity investments are accounted by default at FPTPL. And let me, I think, also remind you and caution you that if you've got investments, equity investments in related party, Financial Instrument Standard Index 109 is not applicable. All the investments in related parties are taken at cost, and that is by virtue of Index 27. So remember that not all equity investments are covered under the purview of 109. If you've got related party equity investments, they're supposed to be covered under Index 27, and they are generally measured at a cost model. And they're also subject to impairment. If I just like to remind you that they are subject to impairment if you've got investment in related party equity investments. But all other unrelated equity investments are covered under Index 109, and they are by default covered under FPTPL unless the company proves that it's not held for trading and chooses the irrevocable option of considering FPTOCI, that's always with no recycling. Then as far as the debt investments are concerned, typically those debt investments which are financial liability for the issuer, in those particular cases, everything depends upon the business model. If the business model is to collect them, hold the investments till maturity, to collect the contractual cash flows, amortize cost. And if it is supposed to be held for trading, then it is FPTPL. And if there is a dual objective, that means you may hold it to maturity or you may sell these investments, then it is supposed to be FPTOCI, that's R. Equity investment is always NR and debt investments is always considered R. Then we went on to the focus in terms of initial and subsequent measurements, all done. Our focus now has been on a special issue with regard to the initial measurement. So I think I'm just going to make a quick mind map on that particular part. So we started a journey in terms of a special issue. We were talking in terms of a special issue which is related to financial assets initial recognition. So when you're looking at the initial recognition of financial assets, so we're looking at the special agenda related to the initial recognition. And what is that? I gave you a 3-step model on that. I said that when you recognize the financial assets initially, they're always measured at a fair value. But then there are cases where we consider a transaction price that you remember, trade receivable, loan payable, recoverable on demand. Otherwise, when you consider the financial assets, it is always measured at fair value initially, and therefore there can be a difference in terms of the transaction price, or you can call it as the transaction value. So call it as a TP or call it as a TV, one and the same thing. So in these cases, when the fair value and the transaction price differs, so there is a difference, what do we do? So we decided a very simple 3-step model in this case, and let me just quickly take a recap and begin. So I said the first thing is you need to see, is the transaction at market terms or off market terms? So basically the focus is to see, is it at market terms or is it supposed to be at off market terms? Now, how do you identify that the transaction is at or off market terms? It is simply a comparison. It is simply a comparison between the contracted rate and the market rate. So if you say that the transaction is at market terms, that means the contracted and the market rate is same. In those particular cases, if they're same, the transaction price and the fair value is, of course, the same. So there is no difference which will arise. But when you say it is supposed to be off market terms, in those particular cases, the contracted rate is less as compared to the market rate. The contracted rate is less than the market rate, and that is the point at which you know that there is a difference arising on initial recognition. And in this particular case, the transaction price would never be equal to the fair value, and this is where the difference would arise. Then you go to the step number 2. So your first thing to be watched out is looking at off-market transactions where you can see the contracted rate is less as compared to the market rate that triggers an off-market transaction. Then we go on to the step number 2 and we see that in this particular case, when you're calculating the fair value, is it based on observable or is it based on unobservable data? And as I said, you can look at the kind of relationships which you're going to see in step 3 and get a fair idea that, in this case, it is observable, unobservable input. But if it is based on an observable data, then in that case, the difference is called a day one gain or loss. I remember there was one examination question, I think it was just around 4 marks or something, which came in the exams where it was a case of an observable data. And in that particular case, the difference between the fair value and transaction price was taken to the P&L immediately. Because this concept of day one gain or loss arises on account of Ind AS 113. That is the concept of fair value measurement. And this day one gain or loss is immediately taken to the P&L. So if there is a gain, it goes in the P&L. If it's a loss, it goes in the P&L. So you need to identify the data of fair value, observable, unobservable. If it becomes unobservable, you go to the step number 3. And the step number 3 is the crucial step where you are going to consider the type of relationship. The type of relationship will decide the agenda, how the accounting is going to be done. And as I said, it's not that I'm giving you an exhaustive list of relationship, but I think more or less the list of relationship which I gave you is based on the inputs in the study material as well as the inputs which are there in the examination questions and the RTP. So broadly we can say there will be 3 kinds of relationship which you're going to see. It's either a case of employer and employee relationship. Let's put it as E and E. That there is supposed to be an employer-employee relationship. Now, when it is a case of employer-employee relationship, in this particular case, we are going to put this difference as a prepaid staff cost. We've already worked on the question on this area, employer and employee relationship. And this prepaid staff cost is supposed to be amortized over the period of the loan on a straight line basis. So it goes in the P&L over a period of time on a straight line method. The second is we can say is the lessor-lessee relationship. Let's call it as L and L, lessor and lessee relationship, which I'm supposed to do right now. Where there is a security deposit, let's say a lessee gives a security deposit to the lessor, and that is maybe a 0 interest rate, or maybe it is at a very nominal rate of interest where the lessor does not pay him any interest as such. In this particular case, we're going to take the difference as ROU asset, and this ROU asset is going to be depreciated over the lease term, or rather I would say depends upon the useful life or the lease term. That is the parameters which Ind AS 116 would decide, because ROU asset is either depreciated on the basis of useful life if the asset is supposed to revert back to the, retained by the lessee. But if it is depreciated on the basis of useful life or lease term, if the asset is returned back to the lessor. So I would say it's depreciated over the life of the asset. the life of the asset would depend upon the parameters of Ind AS 116. And then finally, we said the third kind of relationship is the parent and subsidiary. Let's call it as P and S. Holding subsidiary, or you can say the parent-subsidiary relationship, where it would be considered as a deemed equity investment. Because as a parent, you're putting money into the subsidiary and without getting a return in this case. So that becomes a case of deemed equity investment. And this deemed equity investment is not amortized over a period of time. So this remains as an asset. These two are, of course, amortized over a period of time. So this was the basic essence what we decided. So this is the special issue related to financial assets. I hope, friends, the dots are connected. You made your own revisions as well. Now, let me tell you what am I up to? What am I supposed to do today? So today, to remind you, is the 7th lecture on financial instruments. Wow. We've got another 3 to go, and there's some more interesting issues awaited. That I'll tell you later, not at this stage, though I've already given you a basic mind map in terms of how we are proceeding with this particular standard. Okay, so today my input is I'm going to cover, first of all, the remaining 2 cases on financial assets. Then we are going to come to the concept of financial liabilities accounting as well. And I've also selected 2 very interesting questions which have come in the RTP. And this is one of them is on a financial asset, one of them is on a financial liability, and it blends the concept of Ind AS 21. So I think first we're going to talk about the financial assets remaining cases. Then we're going to talk in deep in terms of financial liabilities, initial and subsequent measurements. Then I have those 2 very interesting questions which are blend of Ind AS 109 and Ind AS 21. 2 questions I remember which I put across will do. Then there is something more, but let's go step by step. So I'm now going to take you to the next agenda, that is lessor and lessee relationship. So I'm already carrying a few questions with me. So one question on a concession loan we had already done. I am now going to take you further. So this question 3, November 20 examination question was done. Now we're going to come to November 2019 question. I guess this should be pretty much visible indeed. Let me know, friends, if this is clearly visible to you. Okay, I think yes, it should be clearly visible. So let's, I think, read this question. This is an oh my God, where did the question go? Disappeared. My God, that's interesting. Okay, let me just load the file again. And I'll just load it again. No worries on that. Seems to be a dangerous question indeed. I think that's the reason it's disappeared suddenly. Yes, here we've got the question. Let me just zoom it across to you. Okay, so I think this is fair enough. We can have a look at the question. Let's see the question number 4 in this case. Now, let me just read the facts. It says A made a security deposit whose details are described below. Make necessary journal entries for accounting of the deposit. Assume that the market interest rate for a similar period is 12% per annum. That's market rate of interest. We can see the starting date is April X1 and the ending date is 5 years. And the lease period is also 5 years. We're given the security deposit and that's it. Nowhere am I given in the question that there is any actual interest rate being given. So I think in the absence, we presume that the lessee made a security deposit and there is no interest which he is getting. So I think undoubtedly we can say the contracted rate is less than the market rate. And in this case, it becomes an off-market transaction. And therefore, if you look at the data, it's a lessor-lessee relationship. So we're going to take the difference as a right of use asset in this case, as simple and straight. So let's, I think, work this out. So we're just going to work out the details on this. So question number 4. So I'm going to, first of all, you can of course make a mention regarding the off-market transaction terminology, but I'm just directly working out the fair value. Now, as I always said, in terms of financial asset, what is a fair value? The present value of all the cash inflows discounted at the market rate of interest. So in this case, if I want to calculate the fair value, so we can say the fair value is going to be the present value of future inflow. So we are not getting any interest on this particular deposit. So we're going to get this 10 lakh money back at the end of 5 years. So we're going to get this 10 lakh rupees back at the end of 5 years. Discount this at 12%, which is 5th year end. And I think that factor is also given in the question. So let's take it as 0.567427. That's 0.567427. So this will give us the present value. Since the factor is already given, we go with the same factor itself. 0.567427 into 10 lakhs. This comes to 567,427. That is the fair value. Okay, that's wonderful indeed. So what is the entry which we're going to do at the inception in the books of the lessee when you made a security deposit? So let's see the journal entry in the books of lessee. So let's see the journal entry which we're going to do in the books of the lessee at day 1. So he's going to put the entry security deposit gets a debit. And what is the value at which the security deposit will get a debit? It's a financial asset. So this will be captured initially at a fair value. And that is 567,427. And he made a deposit. The bank gets a credit. Can I say this will be at the transaction price? That is 10 lakh. So now we can comfortably take the balancing figure. And that's going to be ROU asset. So the difference is going to be taken in the ROU asset. That is supposed to be the balancing figure. As simple and as straight. So let's see what is the balancing figure in this case. I think it's 432,573. So this is the balancing figure, which is ROU asset. Now, you want me to make a security deposit account for the next 5 years? Or do you think if it is manageable, then I'll skip that? And as far as the ROU asset is concerned, I'm just going to make a mention that it's going to be depreciated over the tenure decided as per 116. So you want me, friends, to make the security deposit account, or is that's manageable, then I'll skip that. At least we can make a mention on this that this will be depreciated. This will be depreciated based on life decided, based on the life decided as per Ind AS 116, which is the lease standard. Okay, I think let me see what inputs I've got. So I think answer, there will be no unwinding of security discount in this case. No. I think I should definitely, do this. I should make a security deposit account. So let me, I think, put that question to everybody. Are you going to record a finance income on the security deposit? I think that's better before I make a ledger account. So are we going to attribute a finance income on the security deposit, though we are not getting any interest income, but are you going to still record an interest income on the security deposit for the next 5 years? The answer is a big yes. The answer is a big yes. Let me also tell you one thing very important in the entire Ind AS. Trust me, this is going to be helpful to you whether you do any standard. In any standard, you will see that if you are going to do a discounting today, trust me, you're definitely going to do a compounding in the future. The concept in the Ind AS at many places, you look at many standards like Ind AS 16, you look at Ind AS 37. If you remember, every time you take, let's say, a provision for drawal, Or let's say when you consider a provision in terms of Ind AS 37, where the period involved is more than 1 year, you always consider a discounting. And then there is always a compounding, which is called unwinding of discount. So I think let me just make a leisure account in this case. So on a safe side, let's make a security deposit account for a period of 5 years as well. So we take care of the security deposit in the books of lessee. And this is going to be captured at fair value 567,427. 567,427 security deposit, debit and back gets a credit. Now we start unwinding the interest at the rate of 12% on this. So we take the finance income. That's 12% on this. It is 68091. Now there is nothing which is going to be collected at the end of each year because we're not getting any interest. So as you're going to keep unwinding, you will reach the 10 lakh principal amount at the end of 5th year, and then you're going to get the principal money back. So let's see what is the balancing figure. 567,427, 68091. So this comes to 635,518. And let's again calculate the finance income on this leisure. So this is going to be 4. We'll need another 1 year. So 635,518. 12% on this is 76,262. Let's take the balance CD as a balancing figure. There is 711,780. 711,780. Again, consider a finance income at 12%. 85,414 approximately. So 711,780, 85,414. That is 797,194. So this is 797,194. Again, we consider 12% on this, 95,663. We get the balance CD, balancing figure. That's, I think, 892,857. So I think we make another 5th year ledger as well, just for a good conceptual clarity. So we'll make a 5th year leisure account as well. And now we will definitely reach the 10 lakhs figure. So this is 892,857. Last year, I'll not take the finance income. I'll take it as a balancing figure because you're going to receive the principal amount of the deposit, which is 10 lakh. And you can take the finance income as a balancing figure. That's 107,143. Though this should be approximately 12% on the opening balance. This should approximately match with the 12% figure as well. Let's see if this is coming to approximately the same. Yes, I think it is almost exactly 1 rupee difference, exactly matched. Because we took decimals, almost like 6 decimal places. So therefore, the unwinding resulted in a perfect match. Right, friends, I hope I am now absolutely clear on the agenda. You've got the clarity in terms of security deposit account as well. RU asset is going to be depreciated over the tenure decided as per the parameters of 116 lease standard. And this is how the unwinding of the security deposit would take place. Right, friends, so far so good. I hope you got the clarity of making this leisure account as well. Okay, so let's, I think, proceed. Okay, all right, so the increased depreciation would compensate for the finance income. Yes, indirectly. Okay, I guess another question, sir. Hello, sir. After today's agenda, can you take illustration 31 of ICAI module page 11.126 pertains to conversion of the option with the issuer Not related to the practical measurement, but it is explained the guidance on the measurement. Okay, no issue. You can just remind me towards the end. Once I finish with the financial assets and financial liabilities, before we start the next agenda, please do remind me, though I think I'll remember to tell you that. I think it's in unit number 3, if I am right. The illustration which you've mentioned, correct? So we'll discuss that. That's not an issue at all. Okay, so that's done. So this is another agenda done. Now let's go to the next one. Oh, this was there, but it got disturbed, I guess. Okay, now let's come to the next one, the third kind of relationship. And this is the parent-subsidiary relationship. This is an examination question, which is May 2018 examination question. So just to remind you, we're done with the concept of lessor-lessee, employer-employee. Now we are focusing on the parent-subsidiary relationship. So let's have a look at question number 5, which is pertaining to the parent-subsidiary relationship. May 2018, 8 marks examination question. It says S issued redeemable preference shares to the holding company H, and the terms are given. It is redeemable after 3 years. So the tenure is 3 years. The preference share value is given. The dividend rate is practically 0, whereas the market rate is 12%. So I think this definitely gives us an indication that it is supposed to be off-market term transaction. And then it says, analyze the given situations, applying the guidance in Ind AS 109 and account for this in the books of H Limited. So I think we can see it is an off-market transactions. The relationship is parent-subsidiary. So I think I can directly start calculating the fair value and put the entry there and then. So let me, I think, just do the calculations on the side. So we're going to first of all calculate the fair value. And in this particular case, we are not getting any returns in the form of dividends. The dividend is practically 0%. So only what we're going to get is the money at the end of the third year. I think this discounting rate is slightly a misprint. Let me just rectify this. This is, I think, 0.7. This is to the extent of 0.7118. So this is 0.7118 is the present value factor. You can just rectify that in the question. Okay, so let's get the fair value. So we're going to receive this money, that is 500 lakhs, will be collected at the end of the third year. So this is the present value of the future inflow. We're just going to receive the principal money at the end of third year. So 0.7118 into 500 lakhs, this comes to 355.9 lakhs. And I think I can simply put the entry right away. So one is investment in preference shares gets a debit because we are putting money in the preference shares. So the entry is investment in preference shares. That gets a debit at a fair value, 355.9. The bank gets a credit, which is the transaction price, that is 500 lakhs. And you take the balancing figure, that is deemed equity investments. So we take the balancing figure, this is deemed equity investments. And this will be the balancing figure. This will stand in the books of accounts. There is no question of amortizing this particular figure. So this works out at 144.1 lakh. I think now a small little pertinent question to ask you. Are you going to consider a finance income on this investment in preference share? Are you going to do the unwinding in terms of the finance income the way you did for a security deposit for the next 3 years? I'm pretty confident you're going to give me the correct answer. So what do you say, friends? Are you going to do the unwinding in this particular case? Okay, I think somebody asked me, so what is this unwinding means? Oh, I thought you might have covered this in Ind AS 37, Ind AS 16. Unwinding is nothing but in a simple way compounding. You know what you're doing today, you are basically doing a present value. So when you're taking a present value, what you're doing is discounting. And then in the future, you're going to do what is called compounding. So when you say it is compounding, it is called unwinding of discount. So in entire Indian accounting standards, the concept is very simple. You take a present value today, that's called discounting. And then in the future, you start doing compounding. And that compounding is technical words called UOD, is called unwinding of discount. Right? I guess you got the answer on that. Okay, that's perfect. So that's right. The interest income is going to be recorded in this case as well. So do you want me to make the investment in preference shares? You can say no. I think that would be manageable. Exactly on the same line like the security deposit. So I think I can skip that part unless you want me to do this. I think that's manageable. That's what I get a sense should be manageable. Present value at 12% is 0.635. No. It's not a period of 5 years. It's a period of 3 years. I think if you take 1 divided by 1.12, for a period of 3 years, it's 0.7112. I think you've gone to the 4th year to take the factor, I guess. So I guess manageable, friends. I can skip the leisure. Yes, we can skip that. That's fine. Okay, perfect. So this agenda is done. Now let's come back to the study material so that we can just close the financial assets. But let's have a look at a few questions in the study mat now. So this is a few questions just to give you a connect between whatever we have studied so far. I'm just taking you to a few questions in the study material as well. This is illustration number 17 in the study material, unit number 2. We're in unit number 2, and this is the question in the study material, unit number 2, illustration 17. The heading itself is given trade receivables at amortized cost. Now, quick questions, first of all, friends, to you. When you're looking at a trade receivable, will there be any difference in transaction price and a fair value? Yes or no? When you're going to capture the concept of a trade receivable, will it lead to any difference between a transaction value and a fair value? Yes or no? So let's get the inputs from your side. And that's rightly said, of course, a no. That's absolutely correct. So what will happen to deemed equity investments after 3 years? That will remain in the books of accounts because you've given money and that money is not refundable ever. So that will continue in the books of accounts. It's like, you put in money in the form of equity shares in the company. It's called a deemed equity investment. So that will not disappear. That will remain in the books of accounts. So that's rightly said. There is going to be no difference in transaction price and fair value because this is an exception. I told you that there are 2 areas of exceptions where we do not record this difference. It says H makes a sale of goods to customer on a credit of 60 days. The customers are entitled to a cash discount 5% if the payment is made before a period of 60 days and the interest is charged at the rate of 12% for any payments after 60 days. The company does not have the policy of selling its debtors and holds them to collect contractual cash flows. They do not sell the debtors. Now, let me also tell you something more. Because as we're going to go on to the concept of derecognitions, we'll be connecting these few dots there as well. So the idea of doing this question is, to give you some more data as we're going ahead. A company goes in for a credit sale and creates a trade receivable. Now, please hear me carefully. The company may be in a practice of assigning the trade receivable to the factoring agency, and that is technically called selling its debtors, or you can say it is called assigning the trade receivable. Now, in this particular case, when it says very clearly, the company does not have the policy of selling the debtors. That means when you're looking at a trade receivable, the business model is not to sell the debtors. We do not assign the debtors to a factoring agency. And it says it is to hold them to collect contractual cash flow. So this tells me about the business model test. And this tells me that we are collecting contractual cash flows till maturity. And that gives you the conclusion that we're following the concept of AC. So it says in the above case, since H has got a contractual right to receive the cash flow from the customers, therefore they are financial assets of H and they will be captured at amortized cost itself. Let me just take it further. So the illustration continues on the next page. So I am given the further details. In this case, it says further, the business model is to collect and objective is to hold a trade receivables to collect contractual cash flows till the end of maturity, and such trade receivables recorded in the books represents contractual cash flows that are solely payment of principal and interest if paid beyond a credit period. Therefore, they are classified at AC. Now you can see that both the inputs have been very clearly discussed in the standard. In this particular question, you can say the examiner has discussed both the aspects carefully. Because if you remember that when you're looking at a trade receivable, it is definitely, you can say, a financial asset, which is debt investments. First of all, I would say what we need to do is we should have actually evaluated this part and then we would have evaluated the business model test. So they very clearly made a mention that since you are going to ask interest if the payment gets delayed beyond a period of 60 days, you've got the contractual right to receive the principal and the interest on that principal. CCFC SPPI test passes. And number two, when you look at the business model, we are not assigning the trade receivables to any factoring agency. The objective is to hold them till maturity. So a clear-cut case of measurement at AC. Good example. Let's go further. Now let's have a look at illustration number 18. It says A, the company has obtained the premises from B on lease to carry on its business. The lease contract is 5 years, and as per the lease agreement, A is paid a security deposit to B, which is 10 lakh rupees, which is refundable after the expiry of the lease agreement. How would such deposits be treated in the books of A Limited, which means in the books of the lessee? I think we've just got a little flavor that in this case, the idea is not that we're looking at how the accounting of the security deposit is done in the books of lessee. The idea is to see the classification, that is it being accounted at AC or OCI or a P&L. So see what it says. In the above case, since A has got the contractual right to receive the cash flow from the lessor, therefore they are supposed to be financial assets. Further, the business model of A is to collect, will be satisfied as the objective is to hold the security deposits, to collect the contractual cash flows till the end of the maturity period. And such trade receivables are recorded in the books representing solely payment of principal and interest. Hence, they will be classified at amortized cost in this particular case. So you can notice that in both the illustration 17, 18, the focus has been very clear. The examiner has given the answer in a very systematic manner. Evaluating at the first go, is it a financial asset? 1. Then evaluating the CCFC SPPI test, that is 2. Then evaluating the business model test, that is 3. And then coming to the conclusion that what is the measurement base. So these security deposits, the trade receivables, they all be taken at amortized cost. But let me now also tell you, in terms of the trade receivable, there will be no difference in the fair value and the transaction value. But in terms of the security deposit, if the lessor does not pay you the interest at market terms, then this is also going to lead to a difference between the fair value and the transaction value, which we've already seen in the illustration. Okay, so that was another simple question indeed. Okay, so this is done. Now let's have a look at another one. So this is the application of the three-step model which we have covered, where we're evaluating that we are going to record the financial assets using which particular measurement base. Let's have a look at illustration 19 as well. It says entity A has got a surplus funds 50 million. A has not yet found a suitable investment opportunity, so it buys a medium dated, 5-year maturity, high quality government bonds in order to generate interest income. If a suitable investment opportunity arises before the maturity date, the entity will sell the bonds and use the proceeds for acquisition of a business operation. It is likely that a suitable business opportunity will be found before the maturity date. So what do you think looking at this? Are you getting the sense that the business model is to collect as well as to sell both? Are you getting the sense that it will be taken at FPT-OCI? What do you say? Considering the data in this case, that this investment they've made, which is more like an interim investment, they did not find any opportunities, but as soon as they find the opportunity, they liquidate this investment and park the money in another security. So are we getting the sense that this could be possibly a case of doing both? That's rightly said. Yes. So we can say whether the investment will meet the hold to collect or hold to collect and sell. The government bonds would not meet hold to collect business model because it is considered that they will be sold well before the maturity date. It is likely that such investments will meet the hold to collect and the sell to business model test, so they will be measured at FPT-OCI in this particular case. Wow. So I think we've got 2-3 examples on the application of the business model test deciding the category of measurement. Okay. So this is done now. This will come to later. Illustration 20 will come to later. Now there is something which I need to consider further with you, and that is, this is also done. Yes, now this is another important illustration, number 28. Now watch this very carefully. This is a good illustration. I think it's come in the exams as well, if I rightly remember. So let's have a look at the illustration number 28. Now let me tell you what is there in this illustration 28. Remember, I gave you there are 2 cases where we do not consider the concept of a fair value. And we said we're going to capture at a transaction value. One is a case of trade receivable, which we have just seen in that illustration 17. And the other one is a loan which is recoverable on demand. So this is one of the beautiful illustrations which is come in the exams as well. And this is on the case of a loan. So there are 3 different parts. We're going to read the illustration carefully and solve. It says XYZ is a company incorporated in India. It provides 10 lakh interest-free loan to its wholly owned Indian subsidiary. The parent is given an interest-free loan to its subsidiary, interest-free loan. And then it says there is no TC. So in this case, there will be no impact of EIR. How should the loan be accounted for in the separate financial statements of XYZ, individual financial statements of ABC, and the consolidated financial statements of the group? Wow. Now we're looking at this transaction in the books of the parent, standalone, in the books of the subsidiary, individual, and we are also looking at the treatment in the group financial statements as well. Wonderful. So there are 3 focus points. We're looking at the accounting of this loan in the books of the parent, standalone, in the books of subsidiary, standalone, individual, and in the consolidated financial statements. And there are three scenarios given. The loan is repayable on demand. Now, please hear me very carefully. I'll document these inputs in a summary chart after the illustration is done. When it says the loan is repayable on demand, the concept of fair value would not trigger. And once the concept of fair value will not trigger, in this case, the concept of finance income or finance charge will also not trigger. Hear me very carefully. If a parent subsidiary is entering into a loan transaction which is repayable and recoverable on demand, two important aspects. We will not consider any fair value concept. We will record the loan at a transaction value itself. Number two, no finance income for the parent, no finance charge for the subsidiary, simple accounting. Let's do one thing. Let's first of all go ahead and look at the answer to A. We'll look at B and C later. It says since the loan is repayable on demand, it has got a fair value equal to the cash consideration, which means we are saying that the fair value is equal to the transaction price, because this is a case of an exception. This is a case of an exception. Now, let's go further. It says the parent and the subsidiary recognize a financial asset and liability respectively at the amount of the loan given. Going forward, no interest is accrued on the loan. And upon the repayment of this, both the parent and subsidiary will reverse the entries which are done at the origination. I hope I'm very clear on my thoughts. And let me also tell you that this becomes a very important input in a practical world as well. You'll see if you've done practical audits, you will see many times the parent and subsidiary enter into loan transactions where the parent subsidiary, they're entering into loans which are repayable on demand. And the best part in this case is no interest calculations, no fair value and transaction price differences. They enter into a transaction where it becomes a loan which is repayable on demand. So this has got two dual advantages. And if you're thinking, so this would lead to manipulations, let me also tell you, even if they land up recording an interest income and expense, so at the consolidation level, the interest payable and the interest receivable in any case is going to get cancelled. So in any case, from the consolidation point of view, it would not make any difference. So we can say that if it becomes a loan recoverable payable on demand, there are two dual advantages. The concept of transaction price and fair value difference is not captured. The loan is captured at the origination, the transaction price itself, and no interest is recorded during the tenure of that loan, whatever period it runs. And then the entries are simply reversed. I'll show you now the accounting entries in terms of case A. So now let's have a look at the accounting entries in the books of A, in the case number A. So I think, no, they've not shown that, sorry. It's not shown. It's just simply given out here. No worry, I'll make a summary chart to you at the end. Because out of all my three special issues, this becomes, you can say, an exception. So I'll put that as an exceptional chart. Now, let's go further and let's look at the part B. The loan is repayable after 3 years, and the current market rate of interest for similar loan is 10% for both the holding and subsidiary. Wow. Now, in this particular case, it's a loan which is not recoverable payable on demand. So therefore, this will capture in the off-market transaction. The tenure of the loan is 3 years. And this will get captured in terms of the difference between transaction value and fair value. So let me now put another question to you. Since the loan is repayable after 3 years, and we are saying it's an off-market transaction because there is no interest between the two parties, but there is a market rate of interest. Are you going to calculate the interest, income, and expense in the books of parent and subsidiary? Tell me. In this particular case, are you going to capture the interest payable receivable? Because in any case, it will pass the CCFC SPPI test. The parent will get the contractual right to receive the principal money on maturity, which is the period of 3 years. So are you going to capture the interest income in the books of parent, the interest payable in the books of the subsidiary? And yes, that's rightly said. Of course, yes. Okay, I got a question. Sir, I'm a bit confused on the classification of security deposit as trade receivable, how it works with off-market terms. Okay, I think connect the dots once again. And I'm just going to go out of this illustration just to give you a little connect once again so that you're very clear on our thought processes. I'll tell you how am I working now because it's important to get the chain very correct. So please see this. In terms of financial assets, I'm just giving you a chain of thought. I'm giving you a chain of thought. So please hear this chain of thought very carefully. This is the chain of thought which you need to apply because the main issue is when you're done with the entire standard, then once you sit down in the exams, we need to be very clear in terms of how we proceed with the question. Now, watch this carefully. When you're looking at the concept of a financial asset, when you're looking at the concept of a financial asset, I would say at the time of initial measurement and at the time of a subsequent measurement. Now, there are two things to be watched out. There are two things to be watched out at the time of initial measurement. Number one, the first aspect is that the initial recognition is at a fair value. And the second aspect is to see that is it at market terms or is it at off-market terms? I got your point. Just hear this very carefully. So when you're looking at the initial recognition of the financial asset, there are two connecting points which should come to your mind. Initial recognition is at a fair value and is the transaction at or off market terms? Now you need to see both of them. Now in this case, there is an exception. In this case, there is an exception. The exception is trade receivable and the exception is loan which is recoverable on demand. Now please hear this very carefully, the next sentence which I'm putting. So when you say that there is an exception where the trade receivables and the loan on demand is recorded, this is recorded at a transaction price. This is recorded at a transaction price. So when you say that this is recorded at a transaction price, now, are you going to apply this particular concept? No. I hope you got the dots connected. If you say that there is a trade receivable, if you say there is a loan which is recoverable on demand, you capture things at a transaction price. So the difference between the fair value and the transaction price does not arise. And therefore, the concept of off-market transactions will not occur. So in terms of trade receivable, we did not get into the fact that there is any difference in transaction price and fair value. Because if there is capturing at the transaction price, where is the question of at and off-market terms comes? Now, let's put it now the other one. If you say leaving these exceptions in rest of the cases, I'm saying in rest of the cases, leaving all these exceptions, will this particular concept apply? Yes. Did you get the dots connected? So you can say if it is a trade receivable, don't get into off-market concept. If there is a loan recoverable payable on demand, don't get into that particular concept. So in rest of all the cases, at off-market terms would apply, and where you will look into the type of relationship to decide the agenda. Where you will look into the type of relationship to decide the agenda, wherein we have given you a total of 3 relationships in this case. Lessor-lessee, parent-subsidiary, employer-employee. So these are the 3 cases done. I hope you got the dots connected right. Okay, now coming to the concept of a subsequent measurement, in terms of subsequent measurement, we apply a 3-step model, which I've given you. We apply a 3-step model to decide if it is supposed to be a debt investments or if it is supposed to be equity investments. If it is a case of equity investments, it is by default FPTPL, but it can be FPTOCI as well in certain cases where the irrevocable option is chosen. So equity investment becomes simple in that cases. So majority of the questions when you're working on this area, you'll not see them as equity investments. Majority of the cases when you're working on off-market transactions, you'll not see that they're equity investments. Majority of all these cases will be debt investments, which will be captured at AC, which will be captured at FPTOCI, that is R, or which will be captured at FPTPL. Like a trade receivable is going to be AC. A security deposit is going to be AC. But we saw one of the cases where the company made an investment in a bond and it got a dual objective, and therefore it was taken at this model. I hope you got the dots connected now. I think Ayush, you had put that question. So then security deposit would always be a trade receivable. Well, I think they mention it as a trade receivable in the answer. It's not a trade receivable. You can say it's a receivable. Let's not call it as a trade receivable. I think that term was not correctly used. It should be called as a receivable, not a trade receivable. But I hope you got the dots connected in terms of how we are proceeding. So when you read a question and you say that, okay, this is a trade receivable, my mind tells me no concept of off-market transactions because you're considering a transaction price. When you look at a loan recoverable payable on demand, it's no question of off-market transaction because you're recording things at the transaction price. So in these two cases, do not even think of off-market. Because off-market would arise when you capture at a fair value and there is a transaction price difference. If you're capturing at a transaction price itself, the question of this concept does not arise. In all other cases, yes, you need to dig this further. Right? I guess very clear. Thank you so much. You're most welcome. Okay, now let's go back to the illustration which we were on. So let me just come back on the agenda. So we're looking at the illustration number 28. This illustration tells you about the loans between parent subsidiary, which now you need to filter. Okay, this is loan payable, recoverable on demand, no concept of fair value and a transaction price, no concept in terms of interest. So case A is done. So they've not given the entries, but they've made it very clear that the fair value is equal to the transaction price. You do the entry at the time of giving the loan and reverse the entries on the repayment. That's it. Now let's come to the part number B. So we can say this is a case. We can say this is a case where is a case of exception. Since it is a case of exception, we are not considering the concept of off-market term transaction. Accounting becomes simple. Next. The loan is repayable after 3 years and the market rate of interest is given. Now, this is not a loan recoverable on demand. It's a loan. But does it fall in the case of rest of the cases? Just to be on a safe side, let me ask you. When it says the loan is repayable in 3 years, is this falling in the exception or is this falling in the rest of the cases? I think let's get that data from you. So what do you say, friends? Is this going to be a case of rest of the cases? That's right. Because this is not now a loan recoverable on demand. So is there a concept of off-market transactions in this case? You're going to capture the difference between the fair value and the transaction price? Yes. Are you going to record the interest, income, and expense? Yes. Let's see. Let's, I think, go to the answer to the part number B as well. This is a question which came in the exams as well. It's come in the RTP as well. Let me know, friends, if this is visible. I guess you can see this, right? I can run the answer out here without doing computations, or maybe I can make a ledger account as well. That's not an issue. It says both the parent and the subsidiary recognize a financial asset liability. It says at a fair value on the initial recognition. I'm going to make a summary chart of this because this is one of the most crucial cases of loan between the parent subsidiary. The difference between the loan amount and the fair value is treated as an equity contribution to the subsidiary. That's what we've already seen. And this represents a further investment by the parent. Now you can see that as I use the nomenclature, deemed investment. So what is this value? This is supposed to be the fair value. And what is the bank figure? This is supposed to be the transaction price or the transaction value. And this is the balancing figure in this entry, which we saw in the previous question as well, the 2018 examination question. So the loan in this case, the financial asset in this case is got captured at a fair value, the present value of the principal money. As a parent, the subsidiary is not giving me any interest. He's only giving the principal money back. So the present value of that principal money at the market rate of interest becomes a fair value in this case. Now you can see the interest income is being attributed. There is being an unwinding done for all the 3 years. Is this exactly the way we did in the 2018 question? Yes. You just make a ledger for 3 years. When you take a present value and then you unwind the interest as well, you reach back the 10 lakh rupees, and then that 10 lakh rupees loan is being collected at the end of 3 years. You want me to make a ledger account in this case, friends, or is it good to go? So just let me know if you want me to do that. I can make a ledger as well, or is it good to go exactly on the 2018 examination question line? Okay, it's good to go. Wonderful indeed. Now let's look at the subsidiary. So the subsidiary also in this particular case, what they've done, they've given the entry bank gets a debit, the loan gets a credit in this case. And see the interesting part. I think I'll cut the workings out here. And you can see now the interesting part in the books of subsidiary. Now, this is one question where we are also looking at the books of the subsidiary. Till now, when I was focusing on those 3 cases, we were focusing in terms of the books of the holder. Now, in this case, we're also looking at the books of the issuer, that there is a difference in the fair value and the transaction value, and this is being called as equity. It's called a deemed capital contribution, which is coming from the parent company. So the parent company calls it as a deemed equity investment, and the subsidiary company calls it as a deemed equity, is going to call it as a deemed capital contribution. So equity investment for the holder, capital contribution by the subsidiary, and that is credited to equity. Now you're going to ask me, sir, where are you going to present this in the balance sheet of the company? Trust me, I've seen certain practical situations as well, and this is reflected as a part of the equity, but not in equity share capital. Not in other equity. A separate line item is created, and this is represented as a separate line item. It is presented as a separate line item. You'll see deemed capital contribution appearing under the section equity. You go to equity share capital, you go to other equity, and you go to deemed capital contribution as well. Wonderful indeed. And then you can see that the interest is getting captured, the finance charge is getting captured, and then you repay the loan at the end of the 3rd year. The same unwinding is done. So the parent is taking a finance income, the subsidiary is taking a finance charge, in spite of the fact that there is no interest involved in the transaction. They entered into the transaction where they said no interest is payable and receivable. But that's the beauty of financial instruments. That's what you've seen, that we do not record based on the contract. We look at the substance of the transaction and we decide that there may not be actual payment of interest and receipt of interest, but there is a substance of a legal form. That takes care of the case number B. Now let's go to the case number C. Now see the interesting part in this case. The loan is repayable when ABC has funds to repay the loan. ABC says, I'll repay the money when I have the funds. Is this going to be a loan repayable on demand? Yes or no? He doesn't say that it's a loan repayable on demand. It says that as and when I have funds, when I have the funds to repay, I'll repay the loan. This is not a commitment. This is not a commitment where you're telling the other person that I'm going to pay a loan. This is not payable on demand. So are you going to treat this? Are you going to treat this like case number B? Yes. So I think let's take you further on the case number B as C as well. So let's have a look out here. I'll just crop this bit, leaving the calculations out here. So let's take it out here. Scenario number C. Now see what is given in C, though in the books of the consolidation we yet to discuss. Generally, a loan is repayable when the funds are available, can't be stated to be repayable on demand. Rather, the entity needs to estimate the repayment date and determine the measurement accordingly. If the loan is expected to be repaid in 3 years, if the loan is expected to be repaid in 3 years, the measurement is same as scenario B. That puts us to very dangerous kind of thoughts. In case number C, we are saying that if you say that I'll pay the money as and when I have funds, I'll say, okay, as an auditor, let me please decide a period, a tenure when it is expected to be paid. So it says, if I presume that the loan period is supposed to be 3 years, then the treatment in the part number B and C is same. Otherwise, depending upon the tenure, you will accordingly unwind the interest in that case. Then he says in the consolidated financial statements, the loan as well as the interest income and expenses will get eliminated as intra-group transactions. Hence, the above accounting will have no impact on the console. However, if the loan is in a foreign currency, exchange differences will continue to impact the statement of P&L in accordance with Ind AS 21. Oh my God. I don't know if you're done Ind AS 21 or not. But in terms of Ind AS 21, I can tell you one thing. The interesting part can be merging Ind AS 110 and Ind AS 21. When the parent-subsidiary relationship is there, they've taken loans to each other. In spite of the fact that the loan gets eliminated, the interest income gets eliminated, but the foreign exchange gain loss will not get eliminated, because even though the loan gets eliminated, they're still exposed to the foreign currency fluctuations, and the foreign exchange gain or loss is still going to hit the consolidated profit and loss account as well. That might sound too technical indeed. Let's forget it. Let's not discuss that too much in detail. Okay, so I think it's time to make some interesting charts based on our discussions now in this case. So I think I'm now going to give you some permutations, combinations, and you need to decide. This is purely devoted on the parent-subsidiary relationship, because this is one illustration which is, expanded quite a bit. So I'm just going to come back and make some interesting chart at this stage. So we made this mind map today. I think on this context, I just want to make another small little interesting chart. So I'm going to give you permutation, combinations, and we'll decide the treatment in the separate and in the consolidated financials. If you can answer this particular chart, your funders are going great. So let's talk about a loan. Let's talk about a loan between parent and subsidiary. Between the parent and subsidiary. So I think this needs a special chart, and let's consider all the permutations and combinations. If you can answer this particular chart, then the funders are going great. So we've got a special focus right now. The loan is between the parent and subsidiary. So we can see that there is a relationship. So let me do one thing. Let me consider some permutation combinations, and we'll consider 3 permutation combinations: books of the parent, books of the subsidiary, and the consolidation. So this is in the books of holding company. This is the books of the parent company. This is the books of the subsidiary company. And this is the consolidated financial statements. So we want to look at the treatment in terms of these 3, the books of parent, the books of the subsidiary, and the consolidation. Now, let's consider if it is a loan which is payable and recoverable on demand. It is a loan which is payable as well as recoverable on demand. Now, let's, I think, put some questions to you. You can start answering them as well. If there is a loan which is payable or recoverable on demand, question number 1, is the concept of fair value applicable? Yes or no? When you're looking at the loan which is payable, recoverable on demand, is the concept of fair value applicable in this case? Yes or no? And that's rightly said, no. So can I say if it is a loan recoverable payment on demand, then the concept of fair value is not applicable in this case. So we will capture the loan at transaction price. we will capture the loan at the transaction price itself. And in the consolidation, can I say it'll get eliminated? In the consolidation, it'll get eliminated in this particular case. Okay, let's look at the next agenda. What about the finance income or the finance charge? If it is a case of loan which is recoverable, payable on demand, are you going to attribute any finance income for the parent, finance charge for the subsidiary? Yes or no? And that's right. And in this case, no finance income and finance charge will be done. And this will, of course, get eliminated. So can I say this is a clear-cut case? This is a clear-cut case which falls in exception. This is a clear-cut case which falls in the exception. Which exception? You know, where we capture things not at a fair value, but at a transaction value, because the fair value and transaction price is same. Okay, let's go to the next one now. We are now considering that there is a loan which has got a tenure, let's say a period of 3 years. So now we're looking at a loan which has got, let's say, a tenure of 3 years. First of all, let me ask you, is this falling in the exception? Yes or no? When there is a loan which has got a tenure of 3 years, is that going to fall under the case of exceptions? This is not a loan which is recoverable, payable on demand. So can I say it does not fall? It does not fall in exception. So this is not going to fall under the case of exception in this particular case. That's right. Now, so in this case, are you going to consider the fair value? Are you going to consider the finance income or the finance charge? So can I say the answer is yes, and the answer is a yes. And by the way, if you're going to capture at a fair value, so will this lead to an off-market transactions? Yes. Let me also add something out here. So if you're going to consider this at a fair value, can I say there will be a difference? And where will you take the difference in the books of the parent company? Deemed equity investment. That difference is going to be a deemed equity investment. So this is going to become a deemed equity investment in the books of accounts. Okay, let's go further. So in the books of the subsidiary, are you going to capture the fair value? Yes. And are you going to take a finance charge? Yes. And will there be a difference which will arise in the books of the subsidiary? Yes. What are you going to call this as? A deemed capital contribution. A deemed capital contribution. So in this particular case, we can say this is going to be a deemed, the difference in this entry is going to be called as a deemed capital contribution. This becomes a deemed capital contribution in this particular case. So this is a clear-cut case where the fair value and you can say the transaction price is a difference, and we are treating the difference in the books of accounts of the parent as a deemed equity investments in the books of the subsidiary as a deemed capital contributions in this case. I hope you're able to get the thoughts very clear. And in this particular case, when you say what happens in the books, eliminated, unless we take it as a foreign subsidiary. And then finally, we're looking at a third agenda as well. And this is a loan which has got no tenure fixed. It's no tenure fixed. It says I'm going to give this money once I have the money. You don't fix a tenure. Now let me ask you a question now. Does this fall in the case of exception? No. Are you going to fix a tenure? You tell me. Is this falling in the exception? Of course, no. And in this particular case, am I going to consider and attribute the difference in this case as fix a tenure? Yes. So I think let me pen this down. So in this case, we can say we need to fix a tenure. So the tenure has to be fixed by the companies. They have to fix a tenure, because if they're not fixed a tenure, we'll tell them, boss, sit down and fix the tenure in this particular case. So let's, I think, add on the inputs now. So are you going to consider the concept of a fair value and the finance income and finance charge? I think, let me put it like this, that this is going to be same as point number two. So this is going to be same as the point number two in this case. The same concepts will apply in this case. The only thing is you need to fix a tenure in this particular case. Wow. So this is the summary chart. This is the summary chart, which is, based on that exception. So you can make references to illustration number 28 of the study mat in terms of unit 3, which condenses this entire inputs. Wonderful. Now you can see, that we are going on the highway and we're getting some turns left and right, and we're getting into those gullies as well, the special issues as well. But what is important is you need to get your thought processes very clear. That when you're looking at the financial assets accounting, initial measurements at a fair value triggers the concept of off-market transactions. And the special feature to be done is those three relationships are done, but I think the parent-subsidiary relationship needed a little special devotion of an illustration, which is done in the study. This takes care of my financial assets accounting in detail. So I think before we go further, friends, I need to get your comfort zones on a scale of 10 again. How comfortable you're feeling in terms of a scale of 10 on the comfort zone: financial assets, initial accounting, fair value, transaction price difference, off-market transactions, parent-subsidiary relationships, charts, everything put together. I get the score 9. That's wonderful indeed. Superb. 9.8. That's wonderful indeed. Great. 10 out of 10. That's brilliant indeed. Okay, I got a question. So towards the end of the session, could you please elaborate the thought process of standard setters while carrying out the exceptions of a trade receivables and a loan payable on demand? Okay, I think I'll let you know the answer right away at this stage. You see, first of all, let's understand one thing very clear. The logic is simple. Why did they consider the carve out of the exceptions of a trade receivable and in terms of loan payable on demand? Now, if it is a loan payable on demand, that means I give you the loan today and I say, give me the loan money back tomorrow itself. What is the concept of loan recoverable or payable on demand? I give you the loan today and after a week's time, or maybe after 4 days' time, or maybe after 1 month's time, I say I want the money back. So in this particular case, you cannot attribute and calculate a present value of the future inflow. I think the time value of money itself becomes immaterial in this case. The concept of a difference in a transaction price and a fair value is more attributed, because when you take the present value of the inflow, unless the time value of money is going to be material, where are you going to find the difference? In terms of trade receivable, the tenure is small and it's generally a few months. So the question in this case does not arise. And then, a trade receivable arises out of the concept of Ind AS 115, where if there is a time value of money, if there is a gap, you automatically attribute a significant financing component in terms of Ind AS 115. So there is no question of bringing the interest element out here, because that interest element, if the time value of money is material, because the tenure is greater than 1 year, it automatically gets taken care of 115. And in case of loan repayable on demand, the concept of present value future inflow will be irrelevant, because you're going to take the money after 2 days, 3 days, 4 days, whatever. You got the point right? So therefore, I think in these two cases, technically, it doesn't make even logical sense to introduce the concept of fair value. I think the transaction price itself represents the value at which you transacted, because you're going to settle the transaction in any case in a couple of days or maybe a couple of months or whatever. Got it? You're most welcome. Okay, so this is done. Now we need to go to the next agenda with you. So the few illustrations in between done. Certain illustrations, of course, I'm not doing because they will take care. Oh, by the way, there's another special issue coming in. Before we go to the financial liabilities, there's another special issue coming in. Sir, how many gullies are we going to enter? We entered into the gully in terms of fair value transaction price differences. Now it's time to get into another small route out here on the highway driving, let's, consider another input as well. Now, what is the special issue? Let me discuss. Now, there is another interesting concept which is done in the study material, and that is called the concept of processing fee. That is called the concept of processing fee. So, I'm now going to take you to another interesting agenda, and that is the concept of a processing fee. Illustration number 20 is devoted to that particular purpose. So, I am just now going to make a run again in terms of illustration number 20. Another special issue, friends. Another special issue in this case. I know the next time the mind map is going to be quite heavy indeed. Huh? So it's going to get more heavier in the next once we make a summary chart. But please keep making your own mind maps as well. You could look into the mind maps we've done, incorporate the illustrations, connect the dots. Okay, this is the concept. This is the illustration on this concept. Make your own good mind maps as well. Trust me, if your financial instrument is strong, your consolidations area is all strong, then there's nothing which stops you from, passing exams with good mark. Because I think in terms of the entire Indies, the most crucial technical part in terms of Indies is the financial instrument standards, the consolidation standards. And the good news is, that the Indus 1 is also going to change in the year 27. There is a new standard coming in Indus 118, which talks about the presentation of financial statements, where the entire formatting of the income statement, the P&L is going to undergo a change. And it's going to be applicable, I guess, from 1st April 2027. That's going to be encouraging. I hope, that this is also introduced maybe the next year before, people go for the practical world. This gets introduced into the syllabus as well. It's going to be an interesting treat. And, when you look at that Indus 118, it's something too beautiful where you see the deficiencies under the existing profit and loss account is being wonderfully addressed by the new concept of Indus 118. Okay. Anyway, I think let's come back. Now, we are working on a special issue number 2. Now, what is a special issue? Processing fee. Now, we are discussing another special issue. We're discussing another special issue, and that is the concept of a processing fee. That is a concept of what is called a processing fee. Now, I would say typically this arises in terms of bank loans. Like for example, when you take a bank loan, the bankers would also ask you to pay some amount of processing fee initially at the very inception. So they will say, okay, that we're giving you a loan that there is, let's say, a 0.5% or 1%, let's say, processing fee charge. Now, logically, it's like this. Imagine I'm dealing with a bank. So if I'm dealing with a bank, I told the bank, okay, I want a 10 lakh rupees loan. They say you need to pay me a 1% processing fee. So they give me a check of 10 lakh rupee and I give them 1% of the 10 lakhs, that is 10,000 rupees as a processing fee. So do you think the loan is 10 lakhs? Or do you think the loan is effectively 9,90,000? I think it's 9,90,000. Because what was happening in the good old days, I'm talking in terms of division 1, that is in the accounting standard area. The banks were capturing the entire processing fee as an income and putting it to the P&L on day 1. Now that doesn't make logical sense. If the loan is for a period of 5 years, why should I allow you to consider the processing fee is an income day 1 itself? It should be spread over a period of 5 years. So how are we going to tackle that processing fee? How are we going to spread it over the period of the loan? Incorporate that in the calculation of the EIR. Oh, does this mean that if there is going to be a processing fee, I am going to trigger the calculation of EIR? Yes. Does this mean that you've added a 4th point in terms of EIR calculations? Yes. You see a discount on issue, EIR. You see a premium on redemption, EIR. You see the concept of TC, EIR. Now you see the concept of processing fee, EIR. I think on that background, let's, read the illustration. It says ABC Bank gave a loan to the customer, and it says that carries a fixed interest of 10% per annum for a period of 5 years, and it's 12% per annum for a period of 3 years. Two different loans are given to the customer. One has got a period of 5 years, 10%, and one is a period of 3 years, 12%. Additionally, the bank charges a processing fee, 1% of the principal amount. So there are two different loans, 10 lakhs and 8 lakh for two different tenures. What is the fair value upon the initial recognition of the loan in the books of target, and how will the loan processing fees be accounted for? Of course, this is again a loan, but this time this loan is between unrelated party. Remember earlier we were talking about a loan between a related party, parent and a subsidiary. Now we're looking at a loan which is unrelated party. But in case of unrelated party, the processing fees could create an issue. Now let's see how this processing fee will be tackled. The loans from ABC carries interest at 10 and 12% for two different tenures. Additionally, a processing fee is payable on the principal amount. It is assumed that ABC charges all the customers in a similar manner, and hence this is representative of the market rate of interest. Aha! So when you take that 1% from the customer and you're charging everybody that 1%, can I say indirectly, it is like taking a lesser interest and charging a processing fee. So can I say indirectly, there is a need to increase the effective interest rate. You got the point? So when I tell every customer 1% processing fee, which means I would have slightly lowered down the interest rate and I am charging a processing fee, compensating myself on account of the processing fee and charging a low rate of interest. So there is a need to trigger an EIR. It says amortized cost is computed by computing all the cash flows, blah, blah, blah. Okay, so what we basically going to do, let me tell you out here. It says any transaction fees, which is an integral part of the transaction, are adjusted in the effective interest rate. And how we're going to do this, let's see. Now, what we're going to do in this particular case, you need to calculate a new EIR. How? Let's look at things from the bank point of view. Can I say in this particular case, they gave a loan and immediately they got the processing fee. So can I say the net outflow will get reduced? Please watch this again. I'm looking at the calculation of the IRR. I'm looking at the calculation of the EIR from the banker's point of view. So the bankers would have given a loan. Let's say if I take the first loan, let's say for 10 lakh. So there is a cash outflow of 10 lakhs at time zero, but you immediately go to processing fee. So can I say your cash outflow will get reduced? The returns are the interest which you're going to get, the principal repayments which you're going to get. So if you reduce the cash outflow because of the collection of the processing fee, is the IRR going to go up or go down? Tell me. So when you're going to consider the calculation of the EIR, you are going to consider the cash outflow gets reduced because of processing fee. So with the decreased cash outflow and the same cash inflows, is the internal rate of return, is the effective interest rate going to go up or down? And I think I got the answer. It should definitely go up. It will effectively increase. That's rightly said. That's correct. Wonderful indeed. So what we're going to do now, we are basically going to calculate this. I'm going to show you the workings as well. Yes, I think we got correct answers. I think I got another question. So when somebody asked a question, so when it is brought to us sleepers. Okay, you're talking about Indus 118. I don't know when it's going to come. This is just, optimistic thinking at the moment, what I'm doing. Okay, so let's, I think, go further. The calculation not done, but I think I'm going to show you some good calculations on this. I'm going to show you the detailed workings on this. It says the fair value of this loan is 990 and the fair value of the next loan is 792. Now the effective interest rate will be higher than the interest rate of 10 and 12 so that the processing fee gets recognized as interest income. I think you want me to do the detailed answer of illustration number 20. If you ask me, I'll do it. If you don't ask me, I will not do it. So you want me to give you a detailed answer of this particular illustration? I can take one loan for a period of 5 years or 3 years, whatever you choose, one of the loans, and give you detailed calculations of how the accounting for the entire period of 3 years will take place. You want me to do this? Let's see. If you want, I'll do it. If you're silent, then I don't do this. Yes, definitely. Okay, so let's do this. So I am now going to add this answer to you in detail. Let's go to the answer illustration number 20. So I think I'll take this third year loan. Let me take a shorter one, because the same thing will be done in terms of the other loan as well. So I'll take the 3 years loan. So I am taking the 3-year loan. The calculations are same whether it's a 5-year or a 3-year, but I'm taking it shorter just to explain the broader concept. Let me just come back. So we have given a loan which is at the rate of 12%, a 3-year loan, and the loan amount is 8 lakhs. 8 lakhs at the rate of 12%. So we are taking a loan. This is to the extent of 8 lakhs. And the interest rate in this case is 12%. The tenure is already 3 years, and there is a processing fee. And in this case, there is a processing fee which is to the extent of 1% of the loan amount. So this is the basic detail. Now what we're going to do, since there is a processing fee, there is a need to calculate an effective interest rate. So we'll do the calculations of the EIR. So in this particular case, what you need to do, hit a trial. So we know definitely that the internal rate of return will be definitely more than 12%. Let's say around 13, 14%, or maybe we can take 15%. So let's do one thing. Let's calculate the NPV. Let's calculate the NPV, and we're going to calculate the NPV at 2 different rates. One, I'm taking at 12% itself. Another, hit and trial, I'm taking 15. That 15% is just an arbitrary selection. Hit and trial, because when you calculate IRR, just a hit and trial. So let's take the present value of cash inflow. Let's take the present value of cash outflows, and we will be able to get the net present value. So let me do the calculations now. So in terms of the present value of inflow, you're going to get interest for the next 3 years. So on 8 lakh rupee, there is a 12% interest. So you're going to get 96,000 for consecutive 3 years. Let's see the cumulative factor at 12%. 1 divided by 1.12, 1, 2, 3. This is 2.402. This is the cumulative factor for a period of 3 years. And then we're also going to get this principal money back at the end of third year. So this is going to be 1 divided by 1.12. And this works out, I guess, to the extent of 1 divided by 1.12. This is, I think, 712. This is supposed to be 712 in this particular case. Okay, so we are multiplied the interest calculations, and we multiplied the calculations of the principal money as well. And then as far as the outflow is concerned, there is 8 lakhs, and there is a processing fee 1%, which I'll reduce from here itself. So I'm going to make a reduction in terms of the processing fee. That is 8 lakhs into 1%. That's 8,000. So what do you think we're going to get the NPV in this case? Am I going to get 8,000? I think yes. Can I say I'm going to get 8,000 in this case? So let's consider 2.402 into 96,000, 230,592, 230,592, and this is 792. This is coming to 8,192, though it should have been approximately 8,000 itself. Logically it should be 8,000. Let me see if I can just take the decimals up to 4, 5 decimal places. 1, 2, 3. So this is 71178. Let me take it 5 decimals for accurate results. So this will be 0.71178. And this is going to be 2.4 40,183. So I've taken 5 decimals for accuracy of results. Now let's see what is the present value. 71178 into 8 lakhs, 569,424. 569,424. Yes, this comes now perfect 8,000. Wow. More the decimal places you consider, more the accurate answers you get. So I've taken 5 decimal places to get the exact answer 8. Now let's consider at 15%. So this is going to be 1 divided by 1.15. 1, 2, 3. So this is third year factor at 15%. 0.65752. And this is 2.28323. 28323. That's right. And this is going to be 8 lakhs minus the processing fee, that is 1%. Let's see the NPV. So 96 into 2.28323. This is 219,190. 0.65752. 65752 into 8 lakhs, 219,190. And I think this is coming to 46,794 negative. Please check this, friends, if the calculations are correct, I guess. Just see if the calculations are right in this case. Then I can proceed with my IRR calculations as well. Just vouch me if this is correct. So this is 8 lakh into 65752, 526,016. 526,016. Yes, I think it is 46,794. That's correct, I think, yes. Okay, so now we can calculate the effective interest rate. The effective interest rate in this case is going to be 12% plus. Interpolate. So let's take the difference between the two. So 8 minus minus will become plus, 46,794 plus 8. So we can say we need a difference for 8,000. So 3% is for 54,794. How much is for 8,000? Apply the unitary method. The difference is 54,794. The difference is for 3%. How much is for 8,000? So 8,000 into 3, 54,794. This is, I think, coming to 12.43%, rather 44%. So this becomes my effective interest rate, that is internal rate of return. Good God. Now I am ready to make the leisure account for the further 3 years. Once you have calculated the effective interest rate in this case, now let's make a leisure. So we're going to make the loan account for a period of 3 years. So this is the loan, that is the financial asset. So we capture this loan and the bank gets a debit. Now remember, this is 8 lakhs minus 8,000. Now one thing which you need to be careful on, the TC is supposed to be added to the financial asset, but the processing fee is getting reduced from the financial asset. Remember that part as well. So when you're looking at the processing fee, we can say the processing fee in this case, you can say it gets reduced from the financial asset. This is one thing which we need to remember. So as far as a TC for a FA is concerned, added, and processing fee for FA is concerned, subtracted. Now you'll say, so what is going to happen in terms of financial liability? Don't worry, we'll see that aspect also when we come to the financial liability. How do we tackle that? Okay, so now we are going to attribute a finance income. So this works out at 792. So you're going to consider the finance income at what rate? At 12% contracted rate or the EIR, that's 12.44%. 12.44%. So we're going to consider this at 12.44%. 792 into 12.44, that comes to 98,525. 98,525. Then did we receive something? Yes. We received on 8 lakh rupees 12% interest, that is 96,000. So let's get the balance CD as a balancing figure. So we're going to make the ledger for a period of 3 years. Let's take the balance CD balancing figure. 792, 98, 525 minus 96, that's 794, 525. So that's 794, 525. This becomes the opening. Then again, we take the finance income unwinding at 12.44%. 794, 525, 12.44. That comes to 988,39 approximately. Then again, we receive 96,000. And we get the balance CD again, balancing figure. 794, 525, 98839 minus 96, that comes to 797, 364. So this becomes a balance BD in the next year, 797, 364. Last year, I think I'll not take the finance income. I'll rather take it as a balancing figure to get accurate results, because now you are going to receive the interest and the principal. So 96,000 and the principal of 8 lakhs. Let's take the interest as a balancing figure. And that works out at 98,636. And I think if you just want to make a cross check, I think this should be approximately coming to 12.44% on this. So I think if you work this out, this is approximately coming same, 797,364, 12.44. There is a little difference coming in, I think, maybe due to decimals and all. So there is a slight difference coming in, but approximately it will match. So maybe there could be a little slight difference in terms of the IRR calculations, which could lead to a slight difference. The more you take it till, almost like 4-5 decimal places, you'll get accurate results in this case. So this is how the finance income is getting recognized. And let me also put something further, and you can vouch me. Can I say indirectly, this finance income is got increased over a period of time? Because what is happening, the processing fees led to an increase in the effective interest rate. So indirectly, that processing fee is getting spread over the tenure of the loan in the form of enhanced interest rate recognized over a period of 3 years. Correct? Right, friends. So I think another special issue also done. Okay, so what we have done now is the entire accounting of financial assets. Don't worry, we'll map something in between in terms of, where we went across on the financial assets. But typically, we've done, you can say, 2-3 special issue. The difference between a transaction value and a fair value is 1. The concept of parent-subsidiary loans, which are recoverable on demands, are not 2. And the concept of processing fee, there is 3. But the financial asset accounting is done. Now it's time to give you a break. And I think then we are going to start a journey in terms of accounting for financial liabilities. But once I come back from the break, I'm just going to, just give you the connected dots so that the financial assets, all the special issues done, gets connected at one place. That reminds me, there is another very interesting question which is there in the study material, which is on the concession loan, and there is a prepayment of that loan as well. Oh my God. After the break, friends, don't worry. So I think first take a mental rest in the break, then we'll commence back on that issue. Okay, so I think let's give you a break now, 10-12 minutes. I'll join you back, friends, after the break. Relaxation of mind. So I think let's take the journey forward. Now, before we go forward, I think it's necessary to just connect some dots so that you're very well connected in terms of the financial asset accounting. Though there is another special issue, which has come to my mind, and I'm going to put that in the mind map, but we are going to do that illustration later, not maybe immediately, but let's, I think, first connect the dots to you. So I'm just going to add another inputs at this stage. So now what is coming at the back of the mind is, I would say this is what you need to keep as a mind map in terms of the flow which you are doing in terms of financial assets. So there is a basic concept and then there are certain chains which are coming out. I just want to give you the thought process very clear so we are very well connected with how the flow of discussions is taking place. Now, in terms of financial assets, we've basically seen one input very clear. So what we have seen is one input very clear, and that is when you're looking at the concept of initial measurement. So when you're looking at the concept of initial measurement, so we said the initial measurement is supposed to be at a fair value. But then we said that there are certain exceptions. And the exceptions are the case of a trade receivable and the case of a loan which is recoverable payable on demand. Now let me just pinpoint the special issues of discussions we've had. The first thing is the special issue which arises is in this case. So I can say the special issue number one. The special issue number one, what we have decided in this case is that if there is a difference between the fair value and the transaction value, the transaction price and the fair value, how do you tackle the difference? So that is one special issue which you need to clear in mind. Now, in this case, we said it typically depends upon a three-step model which I gave you. So here I gave you a three-step model in order to understand the nitty-gritties, how you are going to effectively deal with the difference. And if I effectively come to the inputs, you can say in effect it was dependent upon the type of relationship. It was type of the relationship. And in this case, we've done three kinds of questions. One is a case of employer-employee relationship, lessor and lessee relationship, and the parent or the holding subsidiary relationship. Remember, this is the special issue in this case. This is a special issue in this case. That's one. Then we also did another special issue as well. And in this particular case, we've done another special issue number two. We've done another special issue number two. I'm just trying to put things into your mind so that you're very well connected in terms of how the flow of discussions is taking place. The special issue number two is the treatment of processing fee. So in this particular case, when you recorded at a fair value, so we can say that we've done the concept of a processing fee. And we said that this processing fee, what is going to be done? It is going to be reduced from the financial asset, and that would lead to the calculation of effective interest rate in this particular case. So that's like a special issue number two, the processing fee. So this is difference in transaction and fair value depending on the relationship. And this is the special issue, which is in terms of the processing fee. Then we did another special issue. Then I would say we did another special issue, and we did the special issue relating to this. Then we did another special issue. So that was a special issue number three. So though we did not do it in the exact same order, but then there was a special issue number three. And in this case, we did the concept of loan between the parent and subsidiary. So in this particular case, we did the case of a loan which is payable on demand, but it's between the holding and the subsidiary. And what we decided in this particular case is that in the books of holding, there will be a deemed, let's not put this. So in this particular case, it's a loan which is recoverable on demand. Within this, I would say, I covered the concept. So I'm putting an asterisk out here. Let's put an asterisk out here. So here only I covered this issue. So when I was explaining that exceptions, I covered out here that if it is not payable on demand, if it is not payable on demand, then in this particular case, between the holding and subsidiary, the holding would create what is called a deemed equity investment. The holding would create what can be called as a deemed equity investment, and the subsidiary will call it as a deemed capital contribution. So the subsidiary is going to call it as a deemed capital contribution. So this is another thing where we also made a chart as well. So these are the chains which are flowing within that. The transaction and the fair value differences, the processing fee issue, the loan payable on demand. And we decided in terms of the loan payable on demand. So in terms of loan payable on demand, we also decided that there is no finance income and there is no finance charge. Nobody records any finance income and finance charge in terms of loan which is payable on demand as well. Then there is another fourth special issue which I'm yet to discuss. And that special issue is pertaining to this part. So I am putting another asterisk out here. So let me just put that another asterisk, and we've got another special issue. This is the double asterisk. So we've got a special issue number 4, which we have not discussed. There is a special issue number 4 in this case as well. And that is, there is a concession loan, but there is a prepayment of the loan. There is a special question which is given. I remember the name also. The name of the question is called Lovely Limited. And that Lovely Limited is a lovely question indeed. And in this case, there is a prepayment. There is a prepayment of the concessional loan. There is a prepayment of the concessional loan which is given by the employee. So it is within this branch itself, a special question has been given where there is a prepayment of a concession loan. So you can see that there are total 4 chain of thoughts which are got spread across. I hope all this helps. I think Krishan Khan tells me I was about to tell that. I think I've just connected that. This issue I am yet to discuss. Rest of the issue is done. Then coming to the concept of a subsequent measurement. Coming to the concept of a subsequent measurement, there is not much deal. Here we have already covered the concept of a 3-step model. So here I've already covered the 3-step model with you. And along with this, I've also given you 4 charts effectively. I've given you 4 charts as well. And those 4 charts are, remember, the debt investments, a case of FL, a debt investments, case of CFI, equity investments, and derivative investments. So we can say 3 or 4 charts effectively, covering the debt investments, equity investments, derivative investments, all that is done. So this is the complete thought process, how you go to attack. So when you're going to make your revisions in terms of financial assets, I want you to sit down carefully, have a look at this chart and go with the flow that, okay, we've understood this concept. Let me understand the 4 special issues which are connected and the subsequent. So that is the accounting in terms of financial assets. I think this was necessary just to, connect you all the dots together. Getting heavier, but I think it's getting very interesting indeed. And there is a special issue number 5 also. There is another special issue number 5 also, which I have not yet covered, but I'll also, take care of that as well. So there is another special issue 5. There is another special issue number 5 as well. And that special issue number 5 is blending the concept of Ind AS 109 with Ind AS 21. Blending the concept of Ind AS 109 with Ind AS 21, where you've got a foreign currency with a financial asset and liability. That's like issue 5. So when you do your revisions, go on a chronological order to connect the dots, 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 dots. Okay, so what do you want me to friends to do now? You want me to first cover the special issue 4 and 5 and then go to the financial liabilities? I think 5 will of course do it after the financial liability, because in terms of issue number 5, there is one question on FA and one question on FL. So I think we can do issue 5 after financial liability. So you want me to cover the issue number 4 at this stage? Or you want me to first do the discussions on financial liability? What do you want? We'll go with the majority choice. If you want me to discuss the financial liabilities at this stage, then come back to that issue. Or you want me to close and discuss the special issue number 4 as well and then go forward. I'll go with the majority opinion. Let's see what's the inputs coming in. Okay, special issue 4 and 5 to begin with. Okay, somebody said financial liability. There seems to be a tie. Somebody saying financial liability. One is saying issue 4 and 5. We need 1 or 2 more votes to decide that. Please send your votes. I'll accordingly deal with the agenda. Either I'll discuss issue 4 and then go to financial liabilities, or first on that. Nobody gave me any inputs on that. Okay, so I think I take a video call. No, I got some inputs now. Okay, issue number 4, I think that's decided. I think I'm getting input, special issue number 4. Okay, then I think let's go to that. For which I need to share an illustration to you friends on the screen, because that is a very interesting illustration. So that's a bigger one. I'm just going to share that on the screen to you. Just give me a minute. It's given in the combined illustrations. There are some illustrations given on financial instruments, I think in unit number 7, I guess. No, unit 7 is on disclosure. Okay, there is an illustration. Let me just, I think, open this up. I'll just search the button for lovely. So there is a very interesting question which is there. Okay, maybe I can share that question on my own, I guess. Okay, it's not in the illustrations, I think. Just give me a minute. I'll just share it across. Yes, I'm just going to share the inputs to you by shots. So maybe it might look a little small on the screen, maybe. It's a January 21 examination question. Okay, I'm just sharing it on the screen. We just read that across. Please have a look at the question number 32. It says, Lovely Limited. I'll just read it across. Sir, the flow would be first identify the TP, which is after considering discount or premium when any, compare it with the fair value and then adjustment for TC or the processing fee when any. The question wants to test everything in this case. Okay, let's read the question number 32 to you. It's on special issue number 4. It says Lovely has a policy of providing, it says, subsidized loan to its employee for the purpose of, it says, buying 2-wheelers and 4-wheeler vehicles. Simran, who is a sales executive, took a loan for the 4-wheeler from the company, and the following are the terms of the loan. The principal amount of the loan is 9 lakh, and the interest is at the rate of 5% on the first 3 lakh, and it is 8% on the remaining amount. So we've got a differential interest rate relating to the loan. The loan is disbursed on 1st April 17 and the loan tenure is 3 years. There is a prepayment, full or partial payment at the option of the employee. Simran shall remain in service till the end of the loan ends. The principal amount should be recovered in 3 equal installments at the end of each year and will be applied first towards interest 8% bearing principal. So in this case, it's not an equated annual installment. It is equated principal money. The loan is repaid in 3 equal installments. That's 1 lakh each. Sorry, not 1 lakh each, 3 lakhs each. Then he says the accrued interest is paid on an annual basis. The market rate of interest on the comparable loan is 12%. I think we can clearly see that it's an off-market transaction because the interest in the market is at the rate of 12% and we are entering the deal where the interest is paid at 5% and 8% on a slab system. The following table shows the expected contractual cash flows from the loans which is given to Simran. And we are given, as you can see in the chart, the outflow is 10 lakh, 9 lakh. There is a principal inflow 3 lakhs each. The interest is taken at the rate of 8% on the initial, that is on 3 lakh rupee. And then there is a interest which is taken at the rate of 5% on that 3 lakh rupee. And then the principal outstanding is also given. So the interest calculations, the principal calculations all done. Now, Simran prepays that 1 lakh rupees on 31st March 2019. Now, that means the loan is prepaid at the end of the second year. The following table shows the actual flows from the loan. So we're given that 9 lakh is the outflow, the principal is 3 lakh, then it is 4 lakhs because she made a prepayment of 1 lakh, then it is 2 lakhs in the third year. Accordingly, the interest rates, interest calculations of the third year is undergone a change. And the principal outstanding is also undergone a change. You are required to pass journal entry in the books of Lovely considering the requirements of Ind AS 109. So we can clearly see the agenda that it's a mix of two things put together. One is the concept of transaction value and the fair value being different, which is resulting in an employer-employee relationship. So there will be a prepaid staff cost along with which there is a prepayment as well. Okay, so I think we are now going to solve this question. This is a January 2021 examination question. January 2021 examination question. I think it's there in the study mat as well. I'm forgetting where that illustration is. But that is there in the study material also. So let's, I think, begin with the inputs. So I think let's begin with the inputs. In this case, special issue number 4. So this is the question which is January 21 examination question. Just for your reference because not shared on the board. So this is covering my special issue number 4. This is covering my special issue number 4, which is on, you can say, the prepayment. Is covering the concept of prepayment of a concessional loan. It's a prepayment of a concession loan. Because it's a concession loan, it'll lead to a difference in the transaction value and the fair value, which is a prepaid staff cost. So we're going to see something interesting when happens on the prepayment. So at the first instance, what we need to do, we just need to solve the question on a normal manner. So I think the first 2 years leisure will be prepared absolutely in the usual way. So first thing what we need to do, calculate a fair value. So we can say the contracted rate is less as compared to the market rate. So this means it is an off-market transaction. It is definitely an off-market transaction. That is one input we can see. And the second input in this case is there is an employer and employee relationship. There is an employer-employee relationship. So in this case, the difference between the transaction price and the fair value is going to be treated as a prepaid staff cost. So we're going to put this as a prepaid staff cost to be amortized over the period of the loan. So we've got 3 agendas with us. So contracted rate is less than the market rate. There is an employer-employee relationship, and there is a prepaid staff cost, and then there will be a prepayment later. So let me also put that bullet point as well, that there is a prepayment. There is a prepayment at second year end. So our focus is basically to look into this third issue, that if there is a prepayment at the end of second year, how will we tackle that? But that's later. First, let's do the usual accounting. So what we need to do in this particular case is calculate the fair value. So the first instance, we go for the computation. We go for the computation of fair value. So when we're going to calculate the fair value, we need the present value of all the future inflows, the interest which you're going to get, the principal which you're going to get. And can I take all the data from the chart given in the question? The original chart which is given in the question, can I take the same data? Yes. So let's consider 3 years, 1, 2, and 3. We consider the cash inflow. Discount this at the rate of interest. I guess the market rate of interest is 12%. So that we get a present value, which will give us the calculations of the fair value as well. So let's first look at the fair value calculations in this case. So I'm just picking up the information in terms of the inflow. So we know that in this particular case, we are getting the inflows to the extent of 3 lakh plus 48 plus another 15. So 363 is the inflow in the first year. A sum total of the principal 3 lakh, and then there were 2 interest elements, just picking that from the chart. Then in the next year, it is supposed to be 339. And the third year, it is supposed to be 3 lakh 15. So this is the cash inflow, which is the interest and the principal. So this is the sum total of the principal and interest, which is already given in the question. We're just picking that information. Let's discount this at the rate of 12%. So if I discount this at 12%, this is 0.893. This is 0.797. And this is 0.712. So let's get the present value. 363 into 893. This is 324,159. This is 270,183. And this is going to be 315 into 712. That's 224,280. So let's add this up. We're going to get the fair value in this case. So this is 324,159, 270,183. That's 818,622. That becomes the fair value. Great. So I think we've got the data in terms of the calculations that what is the fair value of this loan. Now we're just going to make this loan account for the period of 2 years. Let's see the entry at the inception and then proceed. So let's look at the entry at the initial recognition. So the entry at the initial recognition is going to be the loan gets a debit at a fair value. The bank gets a credit at the transaction price, and the difference is the prepaid staff cost, which is to be amortized over the period of 3 years in this case. So we consider the loan, that is the financial asset, gets recorded at a fair value. This is 818,622. 818,622. Then we record the bank, that is at the transaction value. The loan is to the extent of 9 lakhs. So the loan given is 9 lakh. So we get the balancing figure, and that balancing figure is the prepaid staff cost. So this is the prepaid staff cost, which is the balancing figure. That becomes an entry at the inception. So 818,622 minus 9 lakh, this is 81,378. That is the balancing figure. And this is to be amortized over 3 years. This is going to be amortized over a period of 3 years. That's how the amortization would occur. Great. So now what we need to do in this particular case, once the fair valuation is done, the journal entry at the inception is also done. Now let me make a ledger account for the financial asset for the 2 years. So let's consider the 2 years ledger. I think let's make this complete ledger. So we've got the loan account, which is the financial asset. And I think I also need the prepaid staff cost as well. So we'll make 2 ledger accounts. Let's also make a prepaid staff cost, because there are 2 ledgers identified on initial recognition. One is the financial asset loan and the other one is a prepaid staff cost. So let's capture the figures. So in this particular case, the loan is captured at 818,622 and 81,378. 81,378. This is the figure which is the balancing figure. Wow. Now what do we need to do? Just make the ledger account for the next 2 years exactly the way it is made. Unwind the finance income at the rate of 12%. Keep collecting what you're collecting. Then we'll take care of the prepayments at that stage. So in this particular case, first of all, we need to consider the finance income at the rate of 12%. So let's see what is the 12% interest. 818,622 at the rate of 12%. That's 98,235. And we receive some money at the end of the first year. And that can also be seen from the chart itself. You know, the inflows which you're getting at the end of the first year is 363. So this works out at 363. So we get a balance CD as a balancing figure. And then we go to the next year, that is balance BD. So let's see what is the balancing figure. 818,622, 98235, 363. This is 553,857. So 553,857. Again, we consider the finance income at the rate of 12% on this amount. So let's take a 12% on this. That is 66,463 approximately. And then we also get the money. Now, I'm not recording the money which is including the prepayment. I'm just recording what you were supposed to contractually get at this stage. Let's consider that to be 339. So this is the contractually agreed cash flow without taking that 1 lakh of prepayment. So the ledger gets done at this stage. Now, leave it at this stage. Leave it at this stage. Now there is a question of prepayment. Let me also bring the prepaid staff cost to the second year. So we will amortize 1/3 of this. So straight line amortization. So let's see what is 1/3 of this. 81,378. 1/3 is 27,126. This comes to 54,252. This becomes the balance BD next year. That is 54,252. Again, you do the straight line amortization, 27,126. So this also brings us to the second year ledger itself. Okay. Now, what I need to do in this particular case is you need to recompute the fair value. You need to consider that what is the present value of the remaining contractual cash flows so that we can get what should be the balance in the financial asset ledger. So once the employee makes a prepayment, now you need to sit down and calculate in this particular case, what is the present value of the remaining cash flow. So what we're going to do at this stage. So on account of prepayment, we will now do the calculations of the fair value again. So we will do the calculations of the fair value considering the present value of remaining cash flows. Considering the present value of the remaining cash flows in this case. Now, what are the remaining cash flows in this case? So we are also given the chart in the question where now the remaining cash flows is only to the extent of 2 lakhs of principal and 10,000 interest. So we will take the discounting of that principal remaining and the interest, and this will be discounted at the rate of 12% for a period of 1 year. So let's take the discounting 12%, that is first year end. So at 12%, this works out at 0.893. So this will give us the fair value. So this is 2,10,000 into 0.893. That's 187,530. This is the fair value of the financial asset. So what am I supposed to do now? Is this the balance CD of my financial asset, that is the loan account? Yes. And once I take this as a balance CD, because this is the present value of the remaining cash flows, the difference in the ledger, we'll see where we adjust. So let's go back 187,530. So we get the new fair value computed is 187,530. So this is the new fair value computed. This is the new fair value computed at this stage. Now, any difference in this ledger is the receipt, because out of that 1 lakh rupee, of prepayment, you will be able to get a balancing figure in this ledger. So 553,857, 66,463, minus 339, minus 187,530, we are getting a difference that is 93,790. So this is the figure which is by bank, the prepayment. So basically it's easy. What you need to do is you need to calculate a fair value at the time of prepayment, that once the prepayment takes place, what is the present value of the remaining cash flows, and then any balancing figure in this ledger is the portion of that 1 lakh which stands prepaid. Okay, so I think this is done. So we can close this ledger. And maybe if you want, we can make the ledger for the next year as well, but that's fine. And then the figure which is going to be adjusted out here, out of that 1 lakh rupee, how much is adjusted here? 93,790. So 93,790 gets adjusted here. The difference is the adjustment in the prepaid staff cost. So basically the idea is to get the split of that 1 lakh rupee, that out of that 1 lakh, what pertains to the financial asset and what pertains to the prepaid staff cost. So now whatever is a balancing figure, that is 1 lakh minus, this is 6210. So this difference gets adjusted and you take a balance CD as a balancing figure, which is going to be written off in the next year. So let's see the balance. This is 54252, 27126 and 6210. This is 20916. I think this was not technical. This was, I think, far more simpler. I think this question has also come in the exams in July 21. It came in January 21. It came in July also, 14 marks in the exam. Special issue number 4. Right, friends, I hope you stand absolutely clear now on the issue number 4, that is the prepayment in terms of concession loan. Okay, so far so good. That's right, 818, that was correct. Okay, wonderful indeed. So coming back to the agenda, a 5th issue is left, but out of the 5 special issues, 4 special issues are done. We'll come back to the 5th issue after the discussions on the financial liability. Let's now go on to the financial liability. Now the next 15-20 minutes is going to be very heavy for you. Sir, don't you feel any kind of, feeling towards us? I do. At times, when I'm about to tell these technical things to people, it always, takes me back to the movie, which is like, Munna Bhai MBBS, where, he says that I don't love my patients. He says, if I'm going to love my patients, how am I going to treat them? I think the same is what I need to think as well. I need to say that, I also don't love my patients. Otherwise, how am I going to tell you these technical things? So I am now going to give you some more technicality. One way is that I give you something very smooth on financial liabilities. And that makes your life simple. But you're not going to get conceptual clarities on that. The other one is that I give you a deeper conceptual clarity in terms of financial liability. So what do you want me to do? Make your life simple or give you a conceptual clarity on the financial liabilities and get more deep drive in terms of financial liabilities as well? I'm sure you're going to say that we want a deep drive into this as well. Waiting for the answers on that. Conceptual clarity and a deep dive. That's great. Wonderful indeed. So let me now take you back on the study material. Now we are working on financial liabilities now. So this chart is done. We don't need this. And this is deposits done. We don't need this. And this is also done. This discussions is also done. And I think this also discussion done. This is also done. Let's go to the financial liabilities. These simple illustrations you can manage. It should not be an issue. There are some equity investments given. Okay, now comes the financial liabilities discussion, friends, with you. Now hear me very carefully, because what I'm about to discuss, a few things you may not able to catch and correlate, but don't worry, we'll understand them in good detail. So let's, I think, come back, because there are some more interesting inputs coming in, which we're going to pen down, because the kind of illustrations we're going to do on financial liabilities will cover this deeper discussions as well. It says upon initial recognition, all financial liabilities are measured at a fair value, but then there is again an exception. And I think you know the exceptions already, because one of the exception is a trades payable and the other exception is a loan, which is payable on demand. Just like we had the exceptions in terms of financial assets, we've got the same exceptions in terms of financial liabilities. So all financial liabilities will be measured at a fair value. Now here again, the question is with reference to what happens on the TC, what happens on the processing fee. So what is the accounting treatment of TC for FL? What is the accounting treatment for processing fee for FL? Later. Then he says subsequently, that means on a subsequent basis, the classification of financial liabilities will be as under. Now see what is given. The category number 1, it says measured at AC. The category number 2, it says measured at FVTPL. This is FVTPL. And it says this has got two definitions, liabilities that meet the definition of HFT, held for trading. And it says a contingent consideration which is recognized in a business combination, that is Ind AS 103. Let me explain the second one to you. It says financial liabilities are measured at AC. That's one. Financial liabilities are measured at FPTPL. That's two. They're not measured at FPTOCI. I think that I gave you earlier as well, that financial liabilities are not taken at FPTOCI. They're either AC or they are FPTPL. Now see what it says, that if they are measured at FPTPL, there are two kinds of liability. There are two kinds of liability which will meet the category of FPTPL. One is if the liability is held for trading. For example, a derivative financial liability. A derivative financial liabilities will be held for trading and it will be measured at FPTPL. Then he says there is a contingent consideration. After financial instruments, we'll be starting with consolidation. And in terms of consolidation, we're going to do a standard called Ind AS 103, that is business combination. Where I think, let me just explain in simple words at the time being. A Limited acquires the shares from the shareholders of B. A Limited acquired the shares from the shareholders of B and tells them that I'm going to give you a consideration if certain conditions are met. So you tell them that the purchase consideration which I am going to give you is based on ifs and buts. You tell them that if these conditions are met, I will give you a consideration. So it is contingent upon certain conditions, and that is called a contingent consideration. That contingent consideration is also considered to be a financial liability under the purview of Ind AS 109. But we'll talk about the treatment of a CC when we come to Ind AS 103. But in Ind AS 103, I'll also remind you that in terms of Ind AS 109, we did that contingent consideration, which I'm going to call as CC. The contingent consideration is considered to be a financial liability which is measured at FPTPL. It's a little early, friends, to tell you, but I think I want to still make some statements, so please hear me carefully. Let's go back to the same example. A Limited tells B Limited shareholders. A Limited tells B Limited shareholders, I will give you this contingent consideration in cash. It's a financial liability measured at FPTPL. A Limited tells the shareholders of B, I'll give you the considerations in terms of equity shares, which is variable in number. That's again a financial liability to be measured at FPTPL. Now, A Limited tells the shareholders of B that I'll give you equity shares, which is fixed in number. That is equity instrument, not a financial liability. So when you say that there is a contingent consideration, you need to connect the dots that this is a contingent consideration to be paid in cash, or it is paid in variable number of shares. Then it's going to become a financial liability, which is going to be measured at FPTPL, which means every balance sheet date, the measurement at a fair value, gain or loss, unrealized gain loss goes in the P&L. Did you get the dots? Are you able to connect what I am saying at the moment, I guess? Okay, so I think let's go further on this. Now, in this particular case, let's, I think, take this further into this. Okay, that's wonderful indeed. Now, don't worry, we'll document these notes also very soon out here. So I'll come back to this part as well. Let's go further. Then it says designated at FPTPL. Now, you can see B and C almost looks like the same. B, it says it is measured at FPTPL, and C, it says it is designated at FPTPL. Now, you would recall the concept of eliminating, or you can say reducing the accounting mismatch, where we said, the financial assets or the financial liabilities could be designated at FPTPL. So they meet the category of AC. But you still say that, okay, I'm going to treat them at a fair value through P&L. So trust me, there is a difference between FPTPL directly classified or designated. If it gets designated, then the fair value changes in this case do not completely enter the P&L. You heard me correct. If it is designated at FPTPL, the fair value changes do not get completely into P&L. How? We'll see later. Then he says other specific measurement bases and which changes are taken in the P&L. So there are certain other categories as well. I think let's take you to the other categories also in this case. I guess I'll just probably cut this across. And let's have a look at this part. So this is the other special categories which are given. Now let's have a look at this. So this is the fourth category. So one is FL at AC, one is FL at FPTPL, which has got two elements. One is held for trading and one is a contingent consideration under business combination. The third one is supposed to be designated at FPTPL, and the fourth one is other specific measurement basis. Now, what is in the other specific measurements? Financial liabilities that arise when a transfer of financial asset does not qualify for derecognition or when the continuing involvement approach applies. Oh my God. You would say, so what is this? I'll tell you. I'll tell you what exactly is this. We will be coming to another agenda after the financial liabilities are done. That's called derecognition of financial assets and derecognition of financial liability. Now, what is a derecognition of financial assets? A derecognition of financial asset is removal of the financial asset from the books of accounts. Removal of the financial assets from the books of accounts. Like for example, if you discount a bill of exchange, in school and college, you used to do the entry bank account debit, discount account debit, and the bill receivable gets a credit. And that's a wrong entry, actually. We'll be coming to that position very soon when we come to the concept of derecognition. By discounting a bill of exchange, you can't remove the bill receivable from the books of accounts. Basically, when you discount a bill of exchange from the bank, you've basically taken a loan from the bank. You've basically given the bill of exchange as a security and you've taken money. So you're going to see very clearly. You're going to see later. Let me just give you the thoughts at this stage. The entries which are done on the discounting of bill of exchange, bank gets a debit and bill receivable gets a credit. This entry is technically incorrect. When we come to the concept of derecognition of financial assets, we'll talk of this. But let me tell you, the real entry in this case is you can't remove the bill receivable. If you get a bill receivable discounted, the entry is bank account debit and the financial liability, the loan gets a credit. Now read the input. Financial liabilities that arise when a transfer of a financial asset. When you go to the bank and get a bill of exchange discounted, what are you doing? You are transferring your cash flows to the banker. So there is a transfer of financial asset and it does not qualify for derecognition. In this case, instead of derecognizing the financial asset, we'll end up recognizing a financial liability. So financial liabilities can arise on account of the fact that when you want to derecognize an asset, for example, getting a bill of exchange discounted, the financial asset cannot be derecognized and therefore it leads to a creation of a financial liability. So this financial liability is also measured at FPTPL. Any fair value changes, because he's already said that clear. It says very clearly out here that the fair value changes, where changes are taken in the profit and loss. So this liability which will be taken is also going to be considered in terms of FPTPL. Okay, let's go further. Then he says financial guarantee contracts and commitments to provide a loan at a below market rate of interest. Now, when you say financial guarantees and commitments to give loans below, apparently it seems that they are contingent liability. Let's say, for example, a company took a bank loan. And I give a guarantee to the banker that if he doesn't pay the money, I'm going to pay. It's a financial guarantee. But this financial guarantee as per Ind AS is not a contingent liability. What you might have done in school colleges is that if there is a financial guarantee given, it becomes a contingent liability in notes to accounts. No, not in terms of Ind AS. If you're giving a financial guarantee, it's going to appear as a financial liability in the books of accounts. Or even if you're giving a commitment, you're not given the actual loan, but you're giving a commitment to provide a loan at below market rate of interest, it is measured at the higher of the two. The amount of loss allowance and the amount initially recognized less the cumulative amount of income recognized, blah, 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 blah. So I think let's not get into that. But so are we going to deal with these special issues as well? Yes. There has been a question which came in the RTP on the accounting of a financial guarantee. So we're going to deal with the financial guarantee also separately. So are we also going to deal with this concept that a financial liability is getting recognized because a financial asset is not eligible for derecognition? Yes. These special issues will be covered. This special issues will be covered in this standard itself, where we'll also understand the measurement of the financial guarantee. We'll come back to this para and we'll see how the financial guarantee is accounted. And now we also need to get the dots connected in terms of designation. So this is getting heavier and it's getting painful as well. No worry, let me just connect the dots. Once we are able to work upon all these cases on financial liability, you'll get the complete nature in terms of things. Let me just connect the dots once again to you. When you're looking at financial liabilities, remember that there are 4 categories of financial liability. AC, FPTPL, designated at FPTPL, and certain special cases. By default, your financial liabilities will be measured at AC. Then there are financial liabilities held for trading, as well as contingent consideration under 103 that becomes FPTPL. Then there are certain liabilities which are designated at FPTPL because we want to eliminate or reduce the accounting mismatch. In those cases, they're designated at FPTPL. Now, there is a difference in terms of liabilities accounted at FPTPL and designated at FPTPL. There is a difference because in terms of designated FPTPL, not the entire fair value changes will enter the P&L. We'll see that later. And then the special issues, you've got 2. Financial liabilities arising because a derecognition of financial assets is not possible, or there is a financial guarantee. We're not going to talk about the commitments, loan commitments below market rate of interest. I don't see there is any questions pertaining to that area, so we'll not touch upon that. Now, before we pen this down, I think it's time to first of all give you some connect out here. Now, please have a look at this particular chart. Now, there is something very interesting which is given in this chart, a beautiful chart again. Then I'll pen down the things to you. So as we start, in the next session, of course, I'll first quickly, give you the connected dots and then start the journey. But I want you friends to now start doing cumulative revisions on 109. 32 is done, but I think at least, on 109, you need to do the cumulative revisions to keep getting the grips. Okay, now see the measurements of financial liabilities. Now this is AC. And here we use the concept of EIR. You already know that in terms of amortized cost, we always use the concept of effective interest rate. Now it says if it is FPTPL liabilities, then what do you do? Now in this particular case, you can see something very interesting. It says there is an unrealized gain or loss. And this is split between change in own credit risk and other than the change in own credit risk. Sir, what is this own credit risk? Let's not get worried at this stage. The credit risk is basically the failure to make a payment. Like, for example, if I have given a loan to you, and in this case, you don't pay the money back to me, I'm running a credit risk. I'm running the risk of default. I'm running the risk of not getting my payments, and that is called a credit risk. So in this case, the standard decided that in terms of FPTPL designated at FPTPL, the unrealized gain or loss due to own credit risk, it says, is recorded in OCI if it does not increase the mismatch. And other than the credit risk is recorded in the P&L on a periodical basis. Now, I will not be doing an illustration on this particular area, but I think you should at least theoretically know that this is done. Because, doing this illustration, nowhere it is given in the study or in terms of RTP, it can be hazardous and it can be dangerous in terms of things. So I am not getting into this part, but conceptually you need to know that if there is a liability designated, any fair value changes due to own credit risk goes to the OCI, and other than the own credit risk is taken in the P&L. But if it is a financial liability which is directly held for trading, all the fair value changes are taken in the P&L. No worry, we'll record that. And then it says, if there is a realized gain or loss upon derecognition, it goes in the profit and loss. That's on the realized gain. This is unrealized. This is unrealized in nature. Okay, so I think let's now make some documented bit on this. We're just making a chart on the classification of financial liabilities, the broader categories. Let's add the chart out here. Let's add, oh my God, this is getting heavier for my boat to digest as well. So I'm just going to pen down the thoughts in terms of classifications. We'll start working on the accounting of these particular inputs with you in the next session onwards. I'll just document this bit. We'll start working on all the permutations, combinations with you on the categories which I have given you so far. Okay. So let me just, I think, document this part first. Just going to take a little time. So I'll just pen that liabilities part to you, I think at the appropriate place only, so that once you see these slides, you're able to connect all the dots in that case. Okay, so I think let's add this out here. So I am now looking at financial liabilities. I'm now looking at financial liabilities. And the focus is in terms of measurement of financial liabilities. The focus is in terms of measurement of financial liabilities. And let's divide this in two. So one is the initial measurement and one is the subsequent measurement. So in terms of initial measurement, it is taken at fair value. All the financial liabilities are taken at fair value, but with the two exceptions which I said earlier. So we can say the exceptions is one is the trades payable and one is the loan which is payable on demand. And as far as the subsequent recognition is concerned, broadly four categories. So financial liabilities will basically get categorized into four categories in this case. One is, we'll consider amortized cost. One is FPTPL. One is designated. One is designated at FPTPL. So when you say FPTPL, then there are two categories in FPTPL. One is, you can say, the case which is HFT, held for trading, and the other one is a CC. I'm putting in a CC, contingent consideration arising out of business combination, that is Ind AS 103. So Ind AS 103 would result in this. Designated would be, the designated one would be, which is to eliminate, or you can say reduce, which is to eliminate or reduce what is called accounting mismatch. We've already seen what is the concept of accounting mismatch. Maybe we'll make a run through again. So this is the liabilities which were originally, let's say, at AC, but they're designated at FPTPL to eliminate or reduce the accounting mismatch. And then we've got special cases. And then we've got special cases of liability. So we've got two special cases of liability out here. So one is the special case is financial liability, when financial asset is not eligible for derecognition. When financial asset is not eligible for derecognition. So the financial asset is not eligible for derecognition, that's one. And the next one is supposed to be financial guarantee. That's financial guarantee. So I think pinpoint one thing to you. So we will definitely deal with this in this standard itself. We will also deal with this part in this standard itself. This will be done later. So this will be covered in 103. This is covered when we come to the business combination 103. I'll remind you this part. Designated at FPTPL, I think we've already covered out here. I gave you those liabilities which might be designated at FPTPL. And this is also what we're going to cover later. This will be covered in derecognition. This is going to be covered when we come to the concept of derecognition. And this also we're going to cover here itself. So AC, FPTPL, and you can say the financial guarantees will get covered out here. So main focus will be how to account for the financial liabilities initially and subsequently. So initial is of course the same. Subsequently, we'll tackle all those cases, friends, with you. Wow, I think that gives us a good connect in terms of the financial liabilities introduction. So we're going to proceed with this particular part in the next class, where we'll get deep into the financial liabilities accounting, get all the dots connected. This time it might be looking as scary, but I think once we'll do the questions and all, and we'll make some mind maps on that, you will definitely get connected to every pin and point. Okay, I think that's all, friends, I have for the day, unless you've got questions to ask. So in that case, we have to see whether risk and reward associated with B are substantially trustworthy. Yes, that all I think we'll discuss when we come to the derecognition. Okay, I think you said about a case which is on the IS 32 part. No worry, I think we will come to that. It's going to be too heavy to take that at this stage. So that part we'll discuss later maybe. So I think we'll not get into that discussions. Financial liabilities we'll take care, and then I think we'll discuss that part as well. So the sessions are breathtaking. Don't know how the time flies. That's great indeed, friends. Right, friends. So I think that seems to be all. So I think that's time to take leave from you. Thank you very much. So going to see you in the next class. Thank you. Bye-bye and take care. हाँ जी.